The global economy is recovering from a sequence of large shocks in recent years, with a pandemic followed quickly by a sharp increase in inflation in the wake of Russia's war on Ukraine and its people. The necessity to deal with these immediate challenges meant that the attention given to major long-term challenges has been curtailed in recent years. And one of these major long-term challenges is the slowdown in global economic growth. The IMF forecast for global growth 5 years from now is 3.1%, the lowest it has been in decades. Economic growth can be decomposed into the contribution of employment growth, growth in the physical capital stock, and the growth in productivity, which reflects the technologies and efficiency with which capital and labor are used in production. A key reason for the growth slowdown has been a slowdown in productivity growth. It is important to note that productivity is both a cyclical component, which fluctuates significantly over the business cycle, and also has a structural component, which is more slow-moving and depends on deeper underlying factors. An important part of the more rapid productivity growth of the US relative to the EU since the pandemic is likely explained by cyclical fluctuations in productivity. Over the medium term, a more productive economy raises potential growth by boosting the supply side, thereby contributing to lower price pressures. Cyclical productivity developments also feature in the latest Eurosystem staff projections, where the baseline projection envisages an uptick in labor productivity to offset the impact of higher wages on costs and prices. Labor costs matter more for services firms, and services inflation, which is some 45% of the overall inflation basket for euro area countries, has been slower to fall than other more external components such as energy and goods. However, these data can be volatile, and it can take time to discern what exactly is signal and what is noise. As a result, the ECB's Governing Council will continue to follow a data-dependent and meeting-by-meeting approach to determine the appropriate level of interest rates. At our meeting on the 6th of June, we cut rates by 25 basis points, while also stating that we are not committing to a particular rate path. This leaves policy rates firmly in restrictive territory, given where we see the nominal neutral rate, which is around 2% in latest ECB estimates, and the path for inflation. We will deliver on our mandate, which is price stability in the euro area. And I should add, to answer a question that some commentators have posed, we take account of all influences on macroeconomic developments in the euro area, wherever they occur in the world. But like other central banks, we do not follow the Fed in a mechanistic sense. But my focus today is not on monetary policy or the cyclical component of productivity growth. Rather, today I'll talk about the concerning long-term trend decline in productivity in both the EU and the US. While, of course, measuring productivity is inherently difficult, to put some numbers to this, from 2007 to 2019, US labor productivity growth in the market economy was 1.3%, compared to 2.7% from 1995 to 2007. If we compare this to an average across some of Europe's largest economies, including France, Germany, Italy, Spain, and even the United Kingdom, the numbers are even starker, with labor productivity growth declining from 1.3% to 0.5% over the same period. This decline should be a major concern for policymakers. Productivity growth is central to the sustained increase in living standards for individuals and to the fiscal sustainability of governments in the face of looming challenges such as climate change and the aging population. This is not, of course, a revelation. As Paul Krugman wrote 30 years ago, productivity isn't everything, but in the long run, it is almost everything. A country's ability to improve its standard of living over time depends almost entirely on its ability to raise its output per worker. In the face of such challenges, not least our changing climate, international cooperation and openness is more important than ever. In Ireland, we're very aware of the importance of such interconnectedness. We are a small, open economy on the periphery of Europe, which has benefited hugely, both from being part of the EU and from developing strong economic linkages with the United States. In many ways, Ireland sits between the EU and US, even when it comes to the challenge of productivity growth, where Ireland performs well relative to most of its EU peers. Measurement issues are particularly prominent in Ireland, however. Average annual labour productivity growth between 2011 and 2023 for the whole economy was a remarkable 6.1%. But that, of course, includes some activities undertaken by multinationals which do not reflect the underlying growth of the Irish economy. If we focus instead on domestic-dominated sectors of the Irish economy, labour productivity grew annually by 0.7% on average between 2011 and 2023. So it's from this perspective that today I want to discuss the productivity gap between the EU and the US. I'll start by discussing some of the proximate drivers of the growing productivity gap, namely lower investments to innovation and technological adoption, as well as lower business dynamism more broadly. I'll then dive into some of the structural drivers of these differences by focusing on some important differences between the US and EU product markets, financial markets, and labour markets. And I'll wrap up by discussing what implications this might have for the future. Let's start with a few facts. The first fact to highlight is that the main proximate driver of the slowdown in labour productivity in both the US and the EU is not a lack of investment in physical capital, nor changes in hours worked, but rather a decline in total factor productivity growth. Total factor productivity growth depends not on the accumulation of physical inputs over time, but rather on how productively these inputs are used. It therefore depends on innovation by incumbent firms, firm entry, and new product creation, and the extent to which inputs are efficiently allocated between firms. As with labour productivity, US TFP is well above that of EU economies, with the gap widening from around 13% in 1995 to around 20% in 2019. The second fact to highlight is that the US invests considerably more in research and development than the EU. In 1991, R&D spending was 2.5% of US GDP, but 1.6% of EU GDP. The gap has grown since then. In 2021, R&D spending was 3.5% of US GDP, but 2.2% of EU GDP. Relatedly, US firms tend to be faster adopters of new technologies, particularly information and communications technology. The share of ICT-related patents remains stable in the EU from 1995 and 2019, hovering around 15%. In contrast, this share has increased over time in the US to around 35% as of 2019. In summary, the US invests a lot more in innovation and adoption of new technologies than the EU, although I'm reminded of Robert Solow's comment that you can see the computer age everywhere, but in the productivity statistics. The third fact to highlight is that there has been a notable decline in various measures of business dynamism within the US and the EU. Firm entry rates and the share of young firms in economic activity have declined. Industry concentration and markups have increased. Resource misallocation has risen. The gap between frontier productivity firms and laggards has increased, and job reallocation has declined. All of this suggests that the economic forces of creative destruction, which are so important to aggregate productivity, are declining. A notable difference between the US and EU, however, is that the growth of so-called superstar firms in the US, as coined by David Autor and others, which has led to an increase in industry concentration, has not been as pronounced in the EU. So these are some of the main proximate drivers of the growing productivity gap between the EU and US. I'm now going to turn to some of the deeper structural drivers that could be contributing to these patterns, focusing in particular on the extent of integration in product markets, financial markets, and labor markets. So let's start with product market integration. The EU single market has lowered trade barriers and harmonized many rules and regulations. However, these significant achievements, and despite them, the EU remains a more heterogeneous bloc than the US. Language differences can act as a barrier to trade, notwithstanding the dominance of English. Cultural differences manifest as differences in consumer tastes and preferences, and there remain scope to remove regulatory barriers and deepen the single market. As a result, high productivity firms in Europe have a harder time scaling up to be as large as their US counterparts. This limits resource reallocation across EU industries and countries relative to the US experience, lowering aggregate productivity. It also reduces the incentives of European firms to invest in R&D and innovate, which can lead to persistently lower productivity growth and therefore a widening productivity gap. Technological developments in IT, such as cloud computing and machine learning, may have amplified this dynamic by increasing the benefits of scale. Of course, there must be a balance between enabling firms to grow while ensuring that large incumbents don't become entrenched in their positions and block competition. And so an appropriate competition regulation framework is a very important policy tool. But beyond scale effects, there's also potentially more frictions and rigidities in EU product markets than in the US. Recent IMF work suggests that misallocation has worsened considerably in advanced economies, lowering TFP growth annually between 2000 and 2019 by 0.5 percentage points. Notably, the United States is the only exception, with allocative efficiency improving over the same period. There's a lot of variation across EU industries and countries in the extent of misallocation. Forthcoming work by economists at the Central Bank of Ireland explores this issue and quantifies the extent to which various rigidities, such as the information frictions and the difficulties firms face in adjusting their physical capital, worsen capital allocation and lower productivity across the EU. So now to financial market integration. Despite substantial increases in EU financial integration in recent decades, the US has considerably more integrated financial markets. Recent research has highlighted how differences in institutions across the countries, for example, across EU countries, for example, financial disclosure standards and creditor rights can matter for the concentration of firm ownership. So how might this contribute to the productivity gap between the US and the EU? On the one hand, entrepreneurs and young firms tend to have difficulty obtaining finance before they have built up sufficient revenues and capital as collateral. Deeper and more integrated financial markets make it easier for financial institutions to diversify risk, enabling young firms to grow more quickly, driving business dynamism and hence productivity growth. On the other hand, the depth of financial markets also matters for large firms that already have access to finance. They affect the incentives of private firms to go public, and they can also shift the composition of public firm financing between debt and equity. A notable fact is that there is a greater reliance on debt, in particular bank financing in the EU, while US firms tend to have relatively greater reliance on equity as a source of finance. This matters because equity diversifies risk in a way that bank debt doesn't, potentially enabling firms to invest more in risky ventures. An important avenue for future research will be determining to what extent the differences in the depth of financial markets in the US and EU contribute to the gap in R&D spending. And finally, labour markets. Even though there is free movement of labour within Europe's single market, differences in language, culture, and institutions such as social security and tax rules make migration within the EU a lot more difficult than in the US. One result of this is that in response to economic shocks or new innovations, European firms may not be able to fill positions as rapidly as firms in the US. Beyond such relocation dynamics, however, an additional important feature of the US is its capacity to attract high-skilled migrants. Immigrants accounted for a quarter of new employer businesses in the United States in 2019, up from 18.7% in 2007, and are overrepresented in the high-tech industry and as founders of innovative firms. The agglomeration of skills in hubs such as Silicon Valley and top US universities generates important positive spillovers and plays a key role in driving US productivity growth. EU countries have not had the same success historically in retaining and attracting skilled workers, likely contributing to its relatively sluggish productivity growth. Lastly, aging populations may also impinge on productivity growth in both the US and EU. As people age, the benefits of know-how and experience may be offset by depreciation of skills and more limited innovation, although these effects will be very heterogeneous by occupation and sector. The different structure of labour market institutions between the US and the EU will mediate the effects of the demographic transition on productivity. More flexible labour markets alongside institutions, enabling reskilling and retraining workers as they age, will be all the more important in the face of population aging. In addition, the quality and widespread availability of healthcare will be key to ensuring improved longevity and years of healthy life, which will help offset negative effects of aging on long-run productivity growth. So let me just turn to the impact of the pandemic, the implications of a continued widening of the productivity gap in the EU and the US, and the policy tools at our disposal to provide a boost to growth in productivity in the euro area. And I'll also touch on the implications of the ongoing geo-economic fragmentation. So on the impact of the pandemic, I think it's a bit early to tell whether there has been a change to the trajectory of productivity growth in the EU and US, not least because productivity growth, as I said earlier, has an important cyclical component. But it is worth noting that the US saw a dramatic increase in entrepreneurship following the pandemic, particularly in high-tech industries, with many of these new enterprises now becoming employer firms. Business applications for likely employer firms in 2023 were 30% above their 2019 levels. And in the fourth quarter of 2022, the share of gross job creation accounted for by new establishments reached 13% for the first time since 2004. In contrast, new business registrations in the EU in 2023 were less than 10% above the level in 2019, consistent with a pre-pandemic trend. The US and EU also took quite different approaches during the pandemic to protecting labour incomes, with the US largely insuring workers via unemployment insurance, and EU countries focusing on saving jobs through policies such as short-time work programs. While there are good arguments for both of these, the medium-term impacts of these policy choices on productivity are still playing out. And what if the EU and US productivity gap continues to widen? The first important implication is that divergent steady-state growth paths could imply different neutral rates of interest, R star, in the US and the EU, by which I mean different rates which keep the economy operating at potential without inflationary or deflationary pressures. This would in turn drive a wider gap between policy rates required by the Fed and the ECB to maintain inflation on target, which could affect capital flows, exchange rates, and US-EU trade. Countries like Ireland, which are very connected to the United States, both through FDI and trade, might see exports benefit from a depreciation of the euro and the relatively strong expected performance of the US economy. But this is mediated by the fact that many multinational firms based in Ireland price in US dollars. A second implication is that low productivity growth in the EU will amplify fiscal pressures in the face of other mounting challenges, which will require significant government investment. So what can EU policymakers do? And a few thoughts on this. First, EU member states should continue to remove frictions in product and labour markets and harmonise rules and regulations across countries to improve the functioning of the single market, particularly for intra-EU trade and services. Second, it's important to ensure that competition policy frameworks are equipped to deal with the fast-changing environment in which we live in order to maintain the balance between innovation incentives and competition, particularly as artificial intelligence changes the business and technological landscape. Third, continue financial market deepening and integration within the EU, including through the capital markets and banking unions, as well as providing greater choice to savers and promoting macro-financial resilience. More developed capital markets can ensure that businesses' diversified financing needs are provided for, and that financial frictions don't act as a barrier to innovation and business dynamism. And finally, coordinated EU efforts which increase public investment in support of the development and adoption of new technologies, such as the next generation EU, can provide an important boost to productivity growth. Let me now turn to the theme of my remarks at your conference in Dublin last year. It's too soon to come to definitive conclusions on what the impact of geo-economic fragmentation will have on productivity, or on the differences in productivity between the EU and the US. But if we accept, as I do, that the growth of global interconnectedness over the last 50 years has seen greater efficiency, greater productivity, and greater prosperity for our communities, it is not far-fetched to argue that less interconnectedness could have a negative effect on productivity, if not global welfare. Policymakers will need good evidence based on thorough research to help them make best judgments here. For example, whether interference in the market so that domestic consumers pay to support inefficient domestic producers is in fact enhancing welfare overall. So let me conclude. Over the long run, the only way to increase living standards sustainably is by raising productivity. The slowdown in productivity growth over recent decades is therefore one of the major challenges we currently face. I've already outlined some domestic policy reforms and tools which may help reverse this trend. But this is not just a domestic policy issue. In Ireland, we're particularly aware of the important role of multilateralism and openness in driving growth. Multinational firms in Ireland employ over a quarter of the workforce, with diverse positive spillovers in the broader economy. The wonderful thing about innovation is that ideas are non-rival. Whether progress originates in the US, the EU, or anywhere else, we will all eventually benefit. Greater openness to the free movement of capital and the free movement of people has been an integral part of the EU project and will become all the more important as we look for global solutions to reigniting productivity growth and improving the well-being of all our citizens. Thank you very much.
Governor, thank you very much for an interesting talk. A few questions to start off, and we'll also leave some time for questions from the audience. Can you explain why the ECB is moving ahead of the Fed and whether you see that continuing?
Okay, you could put that question the other way around, which is why is the Fed not moving ahead of the ECB? But let's leave that aside. I mean, in the end, our mandate is price stability in the euro area, and we started a pretty rapid hiking cycle in July of 22. We stopped in September of 23. We've been adopting this meeting by meeting approach, looking at the data. And in the end, we concluded at our last meeting that we had enough confidence to move rates from a restrictive stance to a slightly less restrictive stance. As I said in my remarks, we take in coming to decisions and in looking at the analysis, we do look at global macroeconomic developments, which include what's happening to monetary policy, whether it's in the United States or in Asia or whatever. And the question we ask ourselves is not, is somebody moving before us? The question we ask ourselves is, how are all these developments affecting the European economy? So we made the decision we've made. Are we going to, one of the very clear messages that President Lagarde made at the end of our meeting on the 6th of June is we have no predetermined path. We're going to continue to adopt a meeting by meeting approach. Our next meeting's in July. We meet every 6 weeks. Whether the Fed moves before us by then, I don't know off the top of my head when the next Fed meeting is. I'm sure the Fed will make decisions based on what's happening in the US economy. So I think I'd worry less about which order people make decisions in and think more about what's happening to the global economy. And I think that's really where everybody is coming from. The important thing that everyone needs to be conscious of, and hopefully it's not a surprise to them, but it's amazing the amount of times you have to keep repeating that we are absolutely focused on delivering our 2% target over the medium term in a sustainable way. And that's where we are.
Fair enough. Well, why don't we stay on the global theme? You mentioned geoeconomic fragmentation in your remarks. Can you expand on where you see the big issues and challenges going forward?
Well, I think there are many. The first challenge is to recognize that actually it is happening. I have a sense sometimes that people are talking about it as if it's this theoretical possibility and what might the implications be. But it's happening, right? It's happening in a number of different ways. Firstly, it's happening by the fact that the institutions that we collectively set up to sort of make all this work are now not functioning, really. The World Trade Organization is not really functioning in the way we anticipated. So that's one thing. Secondly, I use the word we very loosely here, but we've decided, for good or ill, that we want to introduce tariffs. Thirdly, the pandemic in particular and the Russia's war on Ukraine led us to suddenly, including other things, incidentally, that ship getting stuck in the Suez Canal. We suddenly realized that our supply chains are quite sensitive and quite vulnerable. So thinking has suddenly gone much more into let's try and be more autonomous with our strategic supplies, inputs, etc. So we are seeing a world that is now choosing to be less connected, to use my language. And as I said in my remarks, my gut feel is that it's too early to sort of give a scientific, definitive view as to whether this is, what exactly is the impact of this. But my instincts are that if you accept that a lot of the prosperity in the world over the last 50 years has been built on connectedness, the likelihood is that we're now entering a world where we're going to be less prosperous. There's more costs. The thing I worry about the most is whether policymakers are really making judgments on a full understanding of what are the implications of their decision making. And I'm not, I'm not sure about. There are different drivers for this, and some of them are completely misguided, and some of them have an underlying good intent, but maybe the implications of that really haven't been thought through. So, I incidentally, I'm going to use this word now, but I have almost stopped using it because it means so many things to people. The word globalization, I don't use that word anymore because I use the word connectedness and international connectedness because I think that gives a much sort of clearer sense of what we're talking about. The connection of people, firms, ideas, capital, and so on. That's what really a lot of the prosperity and peace that we've had over the last 50 plus years has been built on. And when you start sort of reducing that, it is concerning.
Absolutely. Perhaps a question on Ireland specifically. Ireland's positioned itself as a gateway between the US and Europe. Can you give us your views on the Irish economy and how Ireland in particular is navigating any of these challenges?
Well, Ireland is the Irish economy is doing well. We are tomorrow, probably tonight, US time, we're going to be publishing the central bank's latest projections for the Irish economy. But in a nutshell, the economy continues to do well. It's actually operating at capacity. We continue to have, our projections are not as rosy as they were, say, in January 2023, but they're still pretty good. The impact of monetary policy is feeding through. But we continue to have some of the lowest levels of unemployment. We've got record levels of participation in the labour market. Inflation is on a downward trajectory, as it is in the euro area. But operating at capacity means that, there are some structural issues now that are coming to the fore. They've been around for a while, but they're now risk slowing down growth a bit more. So we have a housing challenge, which is not unique to the world, but we have a housing challenge, and it's got to the stage now where businesses are finding it difficult to hire people because they can't be housed. So that's become, this is anecdotal now, but I've heard the story enough for me to feel I can repeat it. Quite a few of the bigger businesses are now buying property to house their employees in. So that sort of constraint has become material. We're still an attractive place for people to want to come to. And a lot of the new jobs that were created in the last 5 years, 2/3 of them, I think, also were filled by incoming immigration. But the government's finances are in a very good position, subject to one thing, which I'll mention in a minute. But we've, considering Ireland, post the financial crash, had to ask for an IMF program. The recovery's been remarkable. The one sort of concern that I have is that some of the government's tax revenues are incredibly reliant on very few, very big multinationals. And you only need sentiment to change just slightly for those funds to sort of disappear.
and I have encouraged, and to be fair to the government, I've encouraged the government, and to be fair to them, they followed through. Firstly, do not assume, I mean, we've calculated in the central bank what we see as excess corporation tax. And we've said, don't plan on spending this forever because it might not be there. And in fact, it will be better if you put it away in the wealth fund. And the government has created 2 wealth funds that are in the process of being set up right now. So that's a sort of good thing. Finally, the other sort of concern I have, again, it's a good concern at one level, which is because the economy is doing so well, government needs to be very careful in its fiscal policy, that it doesn't act too cyclically and add to inflation domestically now that we're on the verge of getting on top of inflation, because we're in a unique situation in Europe where we have a single monetary policy that covers 20 countries, but there are 20 fiscal policies. So there's a much greater need for governments in those 20 countries to support monetary policy, because individually we can't, in Frankfurt, actually sort of target Irish inflation, for example. We target euro area inflation. So that's something which I remain focused on. But in the end, I think the Irish economy is before its growth rates are. Well, we always have challenges measuring growth in Ireland because of the presence of the multinationals. But we're growing better than most of our European peers. And although our growth rates, our numbers are, so we don't tend to use GDP in the central bank. We use modified domestic demand, which sort of strips out some of the activities of multinationals. But the reality is that multinationals in Ireland do employ big numbers of people. Although everyone is focused on the corporation tax that multinationals pay, actually there's a lot of income tax that's paid by the employees of these firms. And, many of them are American. And I keep saying to my UK friends who keep talking about the special relationship between the United Kingdom and the United States, I keep saying to them, if you think you've got a special relationship, you should see the special relationship that Ireland has, which is a very special relationship. And I think that one will continue. I think the links between the US and Ireland are strong and remain strong. The investments that we have in pharmaceutical and in big tech are long-term investments. With the skilled labor force that we have, the beauty of the country, I know some of you have not been to Ireland, so you should go and visit and confirm what I just said. I think it'll remain an attractive place to do business.
Absolutely. We'd love to take some questions from the audience. If you'd like to ask a question, please use your microphone and push the button until it turns green. Sir.
Thank you very much for the event. And in the best ECB tradition, maybe I have 2 questions. One would be, Governor Makhlouf, you said at the beginning that you thought you were still quite far away from neutral. I do remember last week there was a headline coming over Bloomberg, which got our traders quite excited from you. And the headline was, don't know how fast the ECB will carry on, if at all. And so people were saying, oh, look, there is somebody who doesn't know whether they will actually cut more. So I was just curious whether, and I must admit, I didn't see much more than the headline. I don't know whether there was much more, but to kind of whether you could maybe elaborate a bit, how these 2 things together, or maybe you were just misquoted. The other one on the productivity that you were talking about in the speech, it's very easy to be, and particularly when one is in the US, it's very easy to be a negative and bearish about Europe There's all the time stuff going on that isn't great, such as currently with the French elections and all of that. But is there anything that gives you that makes you optimistic that things are actually going in a positive direction in Europe? Or would there be anything you would point to say, no, actually, that's a reason why things are indeed improving, rather than all the stuff one could point to on the negative side? Thank you.
I mean, I'm very positive about Europe. And the thing is, markets and commentators are really focused on the next week or the next sort of couple of months of what's happening in Europe. And, you can't ignore the short term, but if you just sort of stand back and ask yourself, what has Europe gone through in the last few years? The pandemic, this war in Ukraine. We are much closer to the conflict in the Middle East. And actually, the economy's working. And there is growth. There might not be as much growth as the United States, but there is growth. There is a sense of a project that's ongoing, that's positive, that has to meet a whole bunch of challenges, but they can be met. So I at that sort of level, when you think of my own sense is that Europe holds itself back from achieving its potential. The creativity and innovation that exists across Europe leaves me optimistic. I mean, I tend to be this might be unusual for a central banker, but I tend to be an optimistic sort of person. I think notwithstanding all the political challenges and so on, I think, again, if you think about where Europe has been and where it now is, I'm optimistic as where it can be. When it comes to my comments the other day, firstly, there's a very interesting intellectual debate to be had as to what is R star, where is R star, what's the precise number. There was a conference a couple of weeks ago in Korea that one of my colleagues went to, and it was devoted to R star. And I said to him when he came back, I said, okay, so what's the answer? And he said anywhere between minus, I can't remember, to 3.5 or something. So I said, okay, well, that's very helpful. But so, we use 2% as this sort of estimate in the projections, which is probably the only sensible way to proceed. I just think, honestly, it's just an interesting intellectual sort of debate. I'm more focused on what are the numbers telling me, and am I confident that we're on track to get inflation to 2% over the medium term? My remarks last week were more reflective of the fact that I think we're not going very fast anywhere, as opposed to we're not going to go faster downwards. That's still where I am. As I said in my remarks this morning, monetary policy remains restrictive. At some point, it'll be less restrictive because we will have confidence that we've achieved our 2% target. But in the sort of time horizon that goes beyond the next meeting, that's really what I was reflecting.
Governor, when you argue for an appropriate policy, are you approaching it from what the Euro area should have or what Ireland should have?
What the Euro area should have.
And all your colleagues do it the same way, generally?
That's our duty. The reality is that the 20 of us who are sitting, well, there's 26 of us actually, 6 permanent members of the board, but 20 governors, all of us know our own country best. But the discussions in the room are about Europe and the Euro area and what we're seeing.
Thank you. Stephanie?
Thank you very much for your comments. There was an allusion to the trade. Don was talking about or asked you about trade policies, and that could be an impediment to productivity growth. Could you comment on industrial policies that are currently in place in the US and also to some extent in Europe? Do you believe that that is enhancing or could potentially enhance over the long term productivity growth, but at the same time, it seems to be unleashing some, constraints in terms of trade policy?
Yeah, no, so I think, I mean, you're right to mention both Europe and the United States, because one of the things that appears to be emerging in Europe a bit more than perhaps a year or so ago is that we feel the need to follow the United States in industrial policy. Now, generally speaking, industrial policy, I come at it from the perspective of somebody who has worked. I mean, I'm a central bank governor now, but I've worked in the fiscal policy in the past in government. So I'm one of these people who is sort of skeptical about the amount of value that is lost in government intervention. I mean, let's we explain industrial policy as government intervention in markets. So I tend to be a skeptic because I've seen examples both through times I've lived in, but also just in history, of industrial policy ultimately leading to a lot of inefficiency, a lot of waste, and sort of big question mark over whether welfare has been enhanced or not. On the other hand, I'm also, one of the things that I like to say to people is, intelligent thinking, not ideological thinking, is what matters. So you got to look at the facts. And in some countries in the world, industrial policy has, over a very long period, succeeded in lifting an economy. I make no comment on the sort of costs of doing that, but ultimately it's been successful. And that Korea, I would suggest, is probably a good example of that. But industrial policy does have, depending how it's designed, short-term consequences and impacts, especially if it promotes, if you design it to essentially promote your firms against other firms, that may not in the end be welfare enhancing if actually the other firms are a lot more efficient than your firms. So the long and short of it, I think, is what exactly are you trying to do? How well designed are your policies? How well do you understand the impacts of the actions you're taking? And when, this is a key one, when will you know that you've done enough and can draw a line or divert resources into something else? So in a nutshell, industrial policy has its place if it's done well. At some point, I'm also a believer that industrial policy should step back and allow firms to innovate, be dynamic, do their own thing, rely on their own initiative and creativity, as opposed to depending on government support.
I think we have time for just one more question in the back here.
Thank you, Governor. That was really inspiring, and I'm going to be using international connectiveness instead of globalization. I may or may not give you credit for that. But I'm Barbara Simmons. Okay. I'm Barbara Simmons, Vice Chair of the International Law Section of the National Bar, and we're in discussions with the African Continental Free Trade Area Secretariat. In your talk, you mentioned the role of, or possibly the impact of, an older workforce that we have, like here in the United States and in Europe. On the continent of Africa, of course, it has a very young workforce. But can you talk about the implications you see of that in relationship to international connectiveness with the rest of the world?
Well, that's a big question. I think at one level, what is pretty clear is that in Europe and I think in the United States, frankly, in any country that is aging in the way that we're seeing, if people want to maintain their living standards, perhaps they actually want to improve them, but let's say they want to just maintain them, they're going to need workers from somewhere. And if Africa is producing lots more young people, or Asia or anywhere, aging societies are going to need younger people to help sustain their living standards. Some people may think that AI will solve all this and we'll be able to do all technology. Well, I don't believe it. I think one of the interesting challenges for, because you mentioned Africa, this isn't a new challenge, which is, in the end, I think you want to make sure that Africa doesn't just become a source of labor for, Europe or wherever, but actually is a source of innovation for itself. I think that's an important thing. The reality is that we're going to need workers in Europe, wherever they come from, just to keep our living standards at levels that we've got used to. And sorry, this is a massive, massive issue. And people are not spending enough time talking about aging societies. And it's more than just the lack of workers. I mean, the reality is that a lot of our existing, there's an assumption that when people get into their 60s or so, they're going to stop working. I mean, what medicine is telling us is that people will be getting into their 70s and are going to want to carry on working. And we've got to think about what this longevity means for example, the education system. In history, I'm being very general here, we spend the first 20 years of our life sort of studying. We spend the next sort of 40 years of our lives sort of working historically, 20th century history. 40 years of our life working, and then maybe 10, if we're lucky, 20 years post-work. The reality is that the post-work time slot is now going to double. And the idea that you're going to rely on the 20 years studying to sort of meet the needs of an 80, it just doesn't make sense, right? So we have to rethink our education system. Are we going to put all the education of people into those first 20 years? Or will it become part of, the sort of life cycle that you take time out at some point in your 40s and retrain? Because your working life is going to sort of be as long as it was, behind you. Anyway, these are sort of massive questions. I hope people are thinking about them. I think about them only a little bit because I have other things to think about.
Well, Governor, thank you very much for a very interesting session. We're going to go to a short break before we continue, but please join me in thanking Governor Makhlouf.